the those who require the funds. So these financial institutions provide the facilities to the customers. Customers means what? Those who require the funds. So that free of cost they are not going to provide. For the providing arranging of these funds, certain percentage they are going to charge to the customers also. Here different types of loans they are going to offer to the customers. So sometimes working capital they are going to provide, sometimes long term capital they will provide, sometimes to purchasing of fixed assets they are going to provide. It is depends on the requirement of the companies and customers. And types of fund based financial services. Generally, fund based financial services, we have lease finance. It is also called as a equipment leasing and hire purchasing, consumer credit, factoring and profiting, venture capital finance, house finance, and bill discounting. So first one is what? Lease financing. So as I said earlier, lease financing also called as a equipment leasing. So here generally, here leasing means what? It is an agreement between lessor and lessee. So this leasing means, so one party ready to provide the property and another party is ready to use that property. So for the using of that property, they are going to pay the money. They are going to pay the charge. So generally a lease transaction is commercial and arrangement whereby an equipment of owner manufacturer conveys to equipment used right to use the equipment in the return for the lease rental. The lease may be different types. So already yesterday also I explained. So it may be operating lease or it may be finance lease also. It depends on situation. The terms and conditions also involved. Okay. So now this lease also we have two types, that is finance lease. It is also called as a capital lease, and second one is the operating lease. Okay, operating lease. What is the difference between finance lease and operating lease? So finance lease, sorry, capital lease. In this case, lessor transfer the risk and reward incident to the ownership of the equipment to the lessee. See, already I explained there are two parties involved. First one is the lessee and second one is the first one is the lessor and second one is the lessee. So who is the lessor? Who is the lessee? The person who transferred the property. The owner of the first person, the person who transferred the property to use for who agreed to receive some amount and transferred to his property for the use of future case. So this is called as a lessor. So in finance lease, he is going to transfer risk and reward incident of ownership of the equipment to the lessee. But title may not be transferred to the lessee. Ownership will not be transferred. Ownership with him only. The rental or payable installments, so cover of the cost of equipment plus reasonable interest funds invested in the purchaser or manufacturer of equipment. This financial lease involves the financing equipment, purchasing and lending out of the less for the use of without the transfer of ownership. Next one is operating lease. So operating lease, generally all risks and rewards are incidental to ownership are not transferred. Above cases, what happened? It will be transferred from lessor to lessee, but in operating lease, it will be not transferred to the lessee, but it involve only short-term hire. The equipment with the ownership resting with the lessor. So such short-term operating lease are prevalent in the use of motor cars, computers, aircraft, ships. So these type of small properties for the short-term purpose, they're going to enter into the agreement. So in second one is the hire purchase. See, hire purchase, there is a act. So hire purchase act is in our India, it started in 1972 onwards. Hire purchase is an agreement under which goods are let out on hide under the there has option to purchase them accordingly with the terms of agreement. This hire purchase finance type of installment credit. Simply, Generally, we are going to see that whenever we want to purchase any property, instead of payment of entire amount, certain amount we are going to pay as a down payment, remaining amount we are going to pay as a installment. It means what? Their company itself, they are offering the credit to the customers. So when in this hire purchase case, when the transaction is done, that time the property will transfer to seller to buyer, and also the property usage also started by the buyer from the starting when he received the property, that time onwards. But the payment is not received by the seller. So when the seller will give the chance to the buyer, so it is going to receive some amount as a down payment. Remaining amount he allowed to pay, he allowed to buyer to pay the installment basis. When all installments successfully completed by the buyers, then seller will transfer the property. For example, you can take automobile finance. So generally we are going to purchase the cars, autos, bikes on installment basis. So certain amount we are going to pay as a down payment, remaining amount we are going to pay the installments. So when all in EMIs are completed, installments are completed, that NOC will provided to the customer. So when NOC received, that time it means ownership totally transferred from seller to buyer. So that is the theme, that is the thing of hire purchase. Content of hire purchase agreement. Generally, portion of goods delivered to hirer by the owner for use of by farmer. Ownership lies with the person lending only. It involves according to hire by the owner, condition that rent is paid by the farmer to the latter. The rental includes both principal and interest. Each installment is treated as a hire charges. The ownership of property goes to the hirer on the payment of last installment agreed to the upon. So this is the hire purchase content. Consumer credit. Consumer credit means what? Consumer loan refers to the money lent to individual. Consumer finance or consumer loan refers to money lent to individual. So generally, these financial institutions, they are going to offer the loans to the consumers. It is credit extended by the banks, financial institutions to the consumer for purchasing of consumer durable such as a refrigerator, televisions, music systems, furnitures, washing machines. So these all are. So these loans can be broadly divided into secure loans and non-secure loans. These loans sanctioned to the real estate sector like housing loans, attached mortgage, automobile loans, attached with the collateral security vehicle. These loans are security loans. So whereas other type of loans like educational loans, personal loans, non-secure loans. See, it means what? Generally, financial institutions, they are going to provide the loans to the consumers. That loans also we classified into two categories. So that loans based on the categories, so secure loans and non-secure loans. If the banker or financial institution, if they provided loan on mortgage basis, on security basis, that is called as a secured loans. Without any mortgage, if they provided any loan, that is non-secure loans. That is non-secured loans. Next. So these banks, banks and financial institutions do not lend the full value of the asset. Initially, they take an advance of 10 to 25% as an advance from the consumer. For the balance of amount, credit will be extended by the company. So this is very simple. Next one is the bills discounting. Bills discounting means what? The term of invoice discounting or bills discounting or purchase of bill conveys same meaning in case of genuine credit transaction. Seller of the goods to meet his working capital requirement enter into the agreement with the buyers of the goods with the bills of exchange invoice prices. Bills of exchange is a issue use of the period 3 to 6 months generally. In some cases, it is going to use the 9 months. The buyer will accept the bills and seller will be receive the payments at a time of the expiry of the bills and till the time the buyer need to wait for the realization of sales proceeds. In such cases, it will be affected fund requirement of seller. Due to this, seller with the mutual consent of the will raise the a bill by buyer with the will accept the bill. The same bill seller discounted with the financial intermediaries. See, so bills discounting is nothing but a it is generally it is the genuine credit transaction. Seller of the goods to meet the his working capital requirement entire agreement with the buyer. So generally, whenever we pay the whenever we purchase the any goods or whenever we purchase the anything, we enter into agreement with the seller. So generally, it is going to involve the period the 3 to 6 months only. So when he is going to pay, when the customer is ready to pay, certain amount is also going to give the discount by the sellers. So types of bills. So for types of bills, first one is the demand bill. It is payable immediately at site. Demand bill. So generally demand bill means it is payable immediately at site. The bill on which no time of payment due to date is specified. Next one is reasons of bill. So these bills are allowed draw to have a period of credit or term. Usually mentioned the days or months by the drawing. Uses of bills. Documentary bills. These are bills that are accompanied by the documents that confirm that a trade has taken the place between the buyer and seller of the goods. A key document like bills of exchange or draft, which is formal demand for the payment of the exporter and importer. So this generally these bills are depend. These bills of all the bills depends on the situation only. We are going to observe. Clean bill. Clean bill means what? The bills of exchange, draft or checked, drawn payable overseas, and which are not accompanied by the any commercial document, evidence of transaction. As a result, interest rate is charged the bills of higher document. So these are the advantages and disadvantages. So go through once. Next one is the venture capital. This is very important topic. So venture capital means what? Venture capital is the risky money, first of all. So just I will explain within one word. Venture capital means the amount, the capital which is going to invested in the risky projects. So where we are going to invest in risky project or research and development or any startups. So initial stages, these projects are very highly risk involved. So later on, the risk will be going to decrease. So huge amount they are going to use in these projects. So that is called as a venture capital. So venture capital is a risky money which is used for the risky enterprises, either equity or debt of capital. It may be in the new sunshine industry or older risky enterprises. The funds which finance such risky venture are called as a capital funds. Venture capital was originally originated and popularized in USA in the 1960s. In development in the countries, this capital come from the pension funds, insurance companies. Generally, this venture capital, they can mobilize the funds from the pension schemes, insurance companies, and even from the large banks. Some large companies with the excess of funds may be provided this capital to achieve the diversification of market expansion, and a window technology or to share the result and research and development of others. In India, a majority of these above institutions are public sector. Only government or public financial institution can provide the funds of venture capital. So meaning of venture capital. Venture capitalists combine risk capital with the entrepreneurial management and use advanced technology to launch the new products and companies in the marketplace. The innovative high-tech ideas are necessary to risk. It is here the fast concept venture capital setup, venture capital providing the long-term startup, cost, high risk and return projects. Typically, these projects are been highly mortality rates and therefore the attractive to banker and private sector companies. So this is all the entire story of the venture capital. Housing finance. This housing finance received a major focus on among the banking and non-banking financial companies. Housing finance sector in India has undergone the unprecedented unprecedented change, especially over the past 2 decades. Traditionally, chief source of the housing finance was individually personal savings. The personal savings individual supplemented to by borrowing of money lenders. The many houses remained houseless for the several years. See, housing finance is nothing but the loans provided for the construction of individual houses for the personal finance. That is housing finance only. The housing finance services mean to finance services relating to the development of construction of residential and commercial properties. A housing finance companies provide approved by the national housing banks. Next one is the factoring and profited. So yesterday also I explained this factoring and profited. Factoring is a service financial nature involving the conversion of credit bills into cash. See, factoring means what? Behalf of the companies, whatever the consumer credit consumers are there, these financial institution they can collect the money from the customers. They are going to give to the company for doing of these services. They are going to charge certain amount. The company will pay the service charges of factoring to the those who are collecting the debts from the customers. Forfeiting. So forfeiting is the another source of the financing against the receivables like factors. This technique is the mostly employed with the help of the exporter financing goods and exported medium term basis. The financing receivable the pertaining international trade. So here, this is the perfect factoring involved in the domestic customers, forfeiting involving the international payments, collections. Next one is mutual funds. Mutual funds are association of trust public members. See, mutual funds means it is a pool of amounts. The small savings collect the small the mutual funds is a pool of amount. The investments, the small savings collected from the small investors by the financial institutions, that amount again they are going to invest in the big projects. They will get the returns, and that return again they are going to distribute the among the investors, small investors. Insurance services. See, insurance services, generally these insurance services, we have two types of insurance, life insurance and general insurance. Again, general insurance we classified into different categories: automobile insurance, health insurance, and other insurances. So other than life insurances, all insurances is called as insurance services. These insurance companies also working under the control of IRDA. So whatever the insurance we are going to pay, that under the guidelines of IRDA. So insurance principles: indemnity, utmost good faith, and subrogation, contribution. These are the various principles of insurance. Indemnity means what? It means that insurance services, when we are providing the insurance, two parties will involve insurer and insure. Okay. It mean insurer means what? The person who take the insurance, the provider, those who are providing that, these we call as insurance companies. And indemnity means what? It is the insured person, the placed financially same position he was before and event after event occurred. So the basic one more principle is utmost and good faith. The basic principle underlining the insurance act as under good faith, but insurer and insured should be disclose the facts and conditions. So these all are principles go through once. So generally legal basis of insurance companies, insurance act, there is a insurance act in India that is according to 1938. Life Insurance Corporation established in the year of 1956, and General Insurance Business, it is established in the 1972. So that time onwards, these two are insurances acts are working under Indian government, and this is supervisor done by the IRDA. So this is the fund-based financial services. Next, fee-based. See, actually, this all are first unit only it's covered. Again, I explained once. Yeah. So fee-based financial services means what? Simply, I can say that fee-based financial services to providing a financial services by these financial institutions, they are going to charge certain fee only. So that is all are fee-based financial charges. So here, what is the fee-based financial services? What are the various types of charges are there? So first one is the new issue management services. See, issue management services talks about the when company will start, when company will issue the primary first time securities. Generally, this financial institution will take that and they will take the charge to issue of the behalf of the company. They are going to issue the securities to the investors. So here, three types of services they are going to provide. That is the public offer and private placement and rights issue. Public offer means what? Directly they are going to offer the shares to the public, and private placement to the they are going to issue the securities to the in the private institutions, private investors, and rights issue means they are going to offer the securities to the existing shareholders. So this issuing process of shares done by the financial institutions. So that is new issue market. These all are we are going to observe here. Next one is the portfolio management. Portfolio management means what? Portfolio is the combination of different types of securities. So when investor want to buy or sell the any security in the stock market, he doesn't get the 100% of information. Maybe sometimes he's not a expert person also for the purpose of buying and selling. So sometimes some agencies, some financial institutions, behalf of investors, they are going to work, they are going to buy and they are going to sell based on the market movement, market directions, because every day they are engaging these works, so they have a complete knowledge on the market. So that behalf of investor, they are going to buy and sell. That is portfolio management services. And corporate counseling is nothing but a the shareholders are and the sorry, corporate counseling means, see, the company's related information. The merchant bankers can play the substantial role of the reviewing the sick units. So corporate counseling means what? They can explain, they can merge, they can acquire the some companies, they can so when any company want to buy the another company for regarding that information, they are going to provide. When they can merge the even the merging time, acquisition time, or any this point of time, relevant information all are done by these corporates only. Next one is the loan syndication. Loan syndication is nothing but a loan syndication credit. Loan is arranged between two more lending institutions, provide the borrowers of credit facility. Sometimes some business entrepreneurs, when they require the any amount of loan, so that some financial institution they can work behalf of these require lender. They are going to approach the financial institution. They are going to provide that banks. Generally, this they can work between the company and financial institution as an intermediator. Mergers and acquisition services. Mergers and acquisition means when one company want to merge with another company, and when one company want to purchase or acquire the another company, related all the services, all the process done by these institutions. So here there are different types of mergers are there. Horizontal mergers, vertical merger, and conglomerate mergers. So horizontal merger means once the merger of two firms are same industry. So that is called as a vertical or the horizontal merger. For example, two same industry means what? The main objective of horizontal mergers obtain the see horizontal means, for example, there is a company is there, B company is there, A production doing and B will production doing same. They are producing the same type of the business. They are engaging same type of production activities also. So when they have their operations and when they are engaging the same type of industry related works, so that is called as a horizontal merger. Vertical merger means what? The merger occurs between the different stages of production and distribution. Vertical mergers expand the business either forward or ultimate. See, for example, vertical measures within the same industry, either next process or before process, whatever the operations they are doing, whatever operations they are engaging. So two companies are they are going to merge. So that is called as a vertical merger. Conglomerate merger means it involves firm engaging the unrelated lines of business. So different company, the different companies they are going to purchase different companies. So A is doing some services business and B is doing some manufacturing business. So they even service whatever the A is doing that business or they are ready to buy the B. That is the conglomerate merger. Merger motivation, managerial synergy, operating synergy, financial synergies. Generally, these are the mergers motivation. And capital restructuring services. Capital restructuring services means what? So generally, capital restructuring services, see, increase the leverages and decrease the leverages, issue the new debt, issue the new shares, repurchasing of outstanding shares, retirement of outstanding shares. So these all are restructuring means what? The changing of capital movement, the changing of funds. So reasons for the capital restructuring: economic downturn, growth opportunity, merger, leveraged by and sales, transfer of individuals, change in market conditions, change in business goals, directions, hostile takeover, bankruptcy. So these are all the capital restructuring. Merchant banking. What is the meaning of merchant banking? Merchant banks are issued the house of rendering such services, indices per project or corporates with the flotation of new ventures, new companies, preparation of planning, execution, new projects. See, merchant banking generally they are going to provide the financial assistance for the new established companies. So whatever the legal framework is required, this merchant banking is also providing that. Next one is the functions of merchant banking. So generally advise the realization and obtaining the content of central and state government necessary for the project and preparation of economic and technical financial feasibility reports and initial project preparation for free investment surveys and market studies helps the raising of rupees resources from the financial institutions and commercial banks, underwriting the subscriptions if necessary, and assistance in the raising of foreign exchange resources, advise setting up uh, turnkey projects, foreign countries, locating the foreign market, advise restructuring of capital amalgamation mergers, takeovers, and management, investment in trust, charitable trust, recruitment, and professionalism. These all are the functions of. Next one is the functions of merchant banking. Next one is the credit rating. What is the meaning of credit rating? So credit rating, it is essential for the giving of expert opinion by rating of agency by relative willingness of ability of issuer debt instrument or debt servicing obligation time in the full. So generally, we have different bank accounts. We are using different credit cards. So based on your track record, they are going to give some rating. So that rating will indicate your capability of repayment. So that rating, that some of the institutions will work on the how to justify that rating, how to give the credit rating. This all the institutions they are going to work on this. Next one. So types of credit rating. There are different multiple types of rating are there. Bond rating, equity rating, commercial paper rating, sovereign rating. So these all are different ratings. So bond rating means what? Rating the bonds on the debts, securities. And equity rating, about the equity rating, about the commercial paper rating, commercial paper, sovereign rating. So these are the different types of rating, go through ones. Next one is the stock brokering services. Stock brokering services means when the some brokering agencies or brokering institutions, they are going to buy and sell the stocks behalf of the investors. So they are called as a stock brokering services. Next, depository service system. See, depository service system is another type of financial services. Depository is a organization generally where the securities, equities, debts, and mutual funds, insurance policies, etc., of the shareholders are maintained in the electronic form in the form of book entry. So, depository system means what? Generally, every investor they are going to buy the shares and securities and debt. They are going to investment in the debt. So, different areas we are going to invest. So instead of maintaining of general manual book, they are going to record the all these facilities in the electronic layer. It will be functioning like bank account. So everything is recorded online. Here it is securities account is electronic form. It is scriptless and trading paperless. Trading promoted stock market. Investors are not allowed to hold the securities physically form. So that is called as a deposit services. So deposit services generally there are many advantages are there. The securities traded electronically. Currently forgery, duplicate shares we cannot provide. We cannot do the future. Increase the liquidity easily we can convert. It will be reduce the cost of transaction. Prepare of records. All the transaction books of investor can be maintained visibly time to time purpose. And next one is the P2P, pure from debt lending, person to person. So this is different. Pure from the debt lending and crowdfunding raises of the loans are paid back interest. So this is not that much of important. Go through once. Yeah, crowdfunding. What is the meaning of crowdfunding? Generally, crowdfunding is the last to 10 years onwards. It is very famous and very popular crowdfunding. It is a modern way of raising the finance using the various technologies based on the platform sites. It is the practice of raising the funds from the many different bankers, many different backers and crowd in the form of small amount or small portion of capital. All members providing the funds to the ventures are unknown parties. Best example of crowdfunding, US based crowdfunding, Kickstarts 2009. So register member can contribute capital in e-wallet. They can transfer to the portion of investment through the email like PayPal, payment by MobiWiki, so like Paytm. For every transaction, remember that transaction charge as well as commission platforms. See, simply crowdfunding means what? Some financial institutions they are going to collect the small funds from their small amounts, small portions from their wallets, and that after collection of that entire amount, somewhere they are going to invest. That those who are that funding the small portion of the funds, that small investors, they are unknown to each other. So generally this crowdfunding we can raise through the e-wallets, and it is registration is must compulsory. They can transfer their portion of investment e-wallet like PayPal, Paytm, MobiWiki for etc. For every transaction of member need to pay the transaction charges as well as commission platform for providers. In case of equity participation based on the platforms, member transfer their capital to the bank and possibility of that. So it is simply one type of they are going to provide. So this is the story about the crowdfunding. Next, go through once. Hmm. Mm. Yeah, now till now we discussed about the one black. So next black, where I'm going to explain about the in detailed leasing means what, hire purchasing means what, venture capital means what. So next class I'll discuss about this. And black the what is their simple. Yeah, fund-based financial services chapter individually we are going to discuss. Yeah, Maja, yeah, listen. Simply here, whatever the first unit is there, first in unit one, introduction overview of the financial services, whatever is there, we discussing about the what is the importance, what is the meaning, and what is the various types of financial services. The financial services also we classified fund based and fee based. So these whatever services are there in going forward also we detailed individual service wise, it is includes fund based and fee based. Again that only we are going to start, we are going to discuss in the future. So first block, if you are perfect, 50% portion also 50% preparation will be completed. Just go through once. So next unit, I'm going to talk about the next class tomorrow. I'm going to talk that is black 2. I will explain black 2 chapter next class.